One of the things we did was we asked our columnist staff to look at the literature to see what the current thinking was on what is the proper way or the way that best reflects modern finance theory in calculating the cost of capital. And the speaker from the Fed also noted that there seemed to be a consensus developing away from DCF and towards the CAP-M approach in the academic literature. But Dr. Stanger, you mentioned that there was a lot of criticism in the literature about the CAP-M approach. Would it be possible for you to submit some, following this hearing, some of the citations to that literature? Because we did not see much in the way of criticisms of the CAP-M approach compared to the DCF approach in the literature search that we conducted here.
Well, the Fama French article that's cited in Dean Hubbard's statement, and I cited also in 2004 in the Journal of Economic Perspectives, is highly critical of implementation problems with the standard CAP-M. Of course, they're endorsing their own model.
Right. One of the other articles in that same economic journal by Perot very much endorsed the CAP-M model as opposed to the DCF model. So it is a matter of academic debate. But of course, academic debate eventually becomes public policy. And while we try to say, well, that's all academic, we're all prisoners of a dead economist, as you all know. So we saw very, very different betas also in your table 3. And could you elaborate on why these betas were so different? Is it just simply a matter of the time frame? Is it a matter of what's included in the risk factors? I mean, these are substantial differences between the railroads and over time. And
right. Sure. Well, it's because of all the factors you mentioned. Bloomberg uses an estimation period of between 3 and 5 years. Ibbotson uses 2 years. Thompson uses 3. Value line 2 or 3. So that's between 2 and 5 years. That contributes to the variability. Bloomberg uses monthly data. The other vendors listed in that table use weekly data. That contributes to variability. The market proxy, Bloomberg, Ibbotson, and Thompson use the S&P 500. Value line uses the New York Stock Exchange composite. Bloomberg uses a 30-day treasury. The other vendors use something else. Also, value line, Mr. King put it up on the board, and in my table 1, it shows values very close to 1. They have an adjustment factor that basically normalizes everything to get a result very close to 1. So all of the vendors approach this differently. They have their own expertise. I think they're all respected, but they come up with widely different numbers.
so we would have to choose what we would think would be the appropriate time frames, the appropriate methodology, and the appropriate vendor, if you like, for the betas.
Or we
could assume it's 1.
Well, that would be
that would be wrong.
That would be wrong.
We might actually agree with Mr. Motes on that.
Actually, I wanted to address something that the gentleman from the Fed mentioned, and that is, I mean, they could basically do whatever they want. They're not a firm in the traditional sense. I think if you tried to estimate the cost of capital for the Federal Reserve, it's got to be close to the risk-free rate. But they're competing with public firms. So they don't want it, if they just came in as the 95-pound gorilla and used a cost of capital that was close to the risk-free rate, they would drive the other firms out of business. You don't have that luxury. Your firms are publicly traded. I don't think you want to impose that sort of lack of market discipline on them.
Anyone else on that question? Dr. Harder, you seem to suggest that there's more than one appropriate methodology for determining the cost of equity, and that different methodologies should yield similar results when they're based upon consistent assumptions. Is it your position that the board should employ multiple methods of determining the cost of equity simultaneously, or would you think that we should choose one method and then use the others as a cross-check? In other words, would you be more favorable towards us averaging different estimates, or choosing one and then using the others as a cross-check?
I would not favor just picking one. And what I was trying to articulate was if you use 2 or 3 or however many you want to use, and then if they're not giving you consistent numbers, you pursue the question of why am I getting different numbers? It's because there's something inconsistent in the inputs. So my recommendation basically is not to average, but to try to pursue the inputs to the point where you get fairly similar numbers. Now, if at that point you want to say, hey, I've got a 10% and 11%, I'm going to use 10.5, fine. But I would not go into averaging, 7 and 14 and getting a 10.5 that way. I think that would be a mistake. The benefit of the multiple approaches is that they surface the inconsistencies. And that allows you and your staff to drill in and see, okay, what do we think is really going on here? So if you have a 10 or an 11 and you think 11 is the right number, then I would say you ought to come down on 11 and not necessarily average.
Both Professor Hodder and Dean Hubbard had a similar statement that in the long run, these techniques should come up with similar answers. The problem is, to me, while that might be true in theory, it often doesn't occur in practice. And I think in 2005, had you had a second approach as a cross-check, you would have found a wide divergence. I think it's going to be very difficult for you to specify for the parties' satisfaction how you're going to reconcile these differences. And that's the beauty of your current technique. You have one, and the parties have to live with it. But I think if you have additional rulemaking on this, you're going to want to seek a lot of expertise on how to resolve these differences. I think that the problem with the CAP-M has been that it takes a while for it to catch up with this forward-looking nature of DCF. That's why you had a big controversy around the 205 numbers. But it doesn't mean that the DCF was wrong. It means that the CAP-M was lagging.
Well, I guess as an intuitive, as Mr. Ficker points out, that the railroad industry in 2005 had a record year, record profits, which have continued, and the industry is getting healthy. And yet at the same time, we say the cost of capital, suggesting that the riskiness of the industry has gone up or its health has gone down, and that's sort of counterintuitive. And I think that's one of the things that shook us. Say, wait a second, we have this cyclical situation where as the railroads get healthier and healthier and healthier, they can never become profitable because they're never going to make their cost of capital, because the analysts are always going to forecast on infinitum this growth of dividends and earnings.
Actually, the analysts now, their growth forecasts, some of the ones I've looked at for future earnings for the industry are already coming down. It's not that the rates aren't positive, but the rate of growth is decelerating.
If I could add a couple of things to that, it may be, it's also built on a larger base, of course, with the increases that have come. Mr. Motes at the beginning was talking about the measuring stick that keeps going up, and that's what we feel that's happening with the revenue adequacy standard. And as the railroads increase those earnings, they're being paid for by the shippers, our members, and it's starting to feel like Sisyphus just rolling up. It comes back down, and we have to push it up again. So we have a concern with that as well. I don't know if you want to add something as well.
Yeah, I guess I would take a modest issue with Mr. Mote's comment about whether or not the current technology is fatally flawed. I would say that it is, if you have a situation where the growth rate is substantially different from the economy as a whole. And to give you sort of the classic is, suppose that you had an estimate of zero growth for the next 5 years. Would you come out and say the cost of equity was 1.5% when the risk-free rate is up around 5%? You would say this is nonsense, and you would need some kind of an adjustment. Well, we've got the flip side of that. We've got a high rate, and you need some sort of mechanism that will allow that rate to get built in at a high rate, but then gradually decline to something that matches the economy. So I think that where you've got the problem right now is locked into this constant growth rate forever. And I think it's fairly easy to break that problem, get around that problem by mandating multiple rates, different rates in different phases. Now, the difficulty there with the economists is, they're going to have different views on what the rates ought to be, where the phases should start and end, and you're going to have some fuzziness. I mean, this is not going to be a very mechanical process, and I think that the best way to wrestle with that issue is to come at it from a couple of different directions, and then try to force a set of assumptions on the growth rates and the timing of the growth rates that seems reasonable and is consistent with what you're getting in terms of risk adjustments from the other methodology.
Dr. Sango, you're good.
Well, I hope you all heard something in Professor Hodder's initial remarks, and that was when an industry is growing at less than the average of the economy, in the long run, that industry will disappear. So the railroad industry, if you look over the past 20 or 30 years, its growth rates have been substantially less than the S&P 500. It has traditionally been a capital starved industry, one in which you found it to be revenue inadequate year in, year out. It's odd to me that in 1 year in which suddenly they're doing better, there's a lot of clamor about, wait a minute, this is too good. There's the concern, and I think it's somewhat tongue-in-cheek that Professor Hodder mentions that, well, in 100 years, the railroad industry will be bigger than the rest of the economy. I can assure you that will never happen. That's one forecast I'm confident in. Maybe 100 years ago, the railroad industry was a very big part of this economy. Today, firms like Microsoft, a single firm has a market cap that's bigger than the entire rail industry. Its day in the sun is today. No question about it. It's doing better. Its earnings are growing faster than the S&P 500 average. But how long will that last? Probably not very long.
You said that the initial, the WCTL raised this issue for the growth in 2005, the increase in 2005, but isn't it true that your initial filing was back before that?
We had made a filing at least several years ago, and at that time we were criticized for not having put in a specific calculation. This time we did put in a specific calculation.
But the concern about this kind of cash flow as an approach that overstates.
Well, as to the realism of the board's calculation, it goes back. I think you could go back to I think it was Commissioner Owen's concurrence or dissent, maybe 9 or 10 years ago. I would need to check when he said that what the board's revenue adequacy findings at that time were not consistent with the perception in the investment community. It's a problem that's been around. It's not new. We would object to statements that this methodology has been producing accurate, sound results for the past 25 years.
Don't go back too far, because you're going to get back where you're going to find the shippers complaining and urging your predecessor to discard the CAPM even as a correlation item, which is the way it was being used. And the ICC did that.
That was my next question, that the railroads do claim that the shippers did oppose the CAPM approach about 10 years ago in a hearing, and it seems that the views have changed, or maybe it's longer than that now.
I believe it was at least probably 25 years ago,
okay.
I think I was probably maybe I was out of law school at that time, but
I'm older than you, Bob. It's more like 20 years ago.
I think it goes well. The decisions I did look at showed that the CAPM was coming in with a figure that was very close to the DCF. Technology resources at that time were not at the level of development and sophistication they are now. It could well have been a very significant burden for what worked out to a small difference, and as Dr. Hodder would point out, if the two were converging at that time, that would have been a healthy sign. That they don't come anywhere near converging now. Also, the state of the industry is different from what it was back then as well. And you can also see what's happening in the academic literature and what's being used elsewhere as well. And the board's current methodology, it may be relatively simple, it may be easy to administer, it may be mechanical, but it's not realistic in today's circumstances.
Commissioner Mulvey, just one other comment you made, and that was about the health of the industry relative to beta. I think beta has increased for the rail industry in the last 3 or 4 years, but that's not necessarily a sign of ill health. The technical definition, if you'll permit me, for beta is the covariance of the return of a firm with the return of the market, if you will. And so I think what this is picking up is that because there was this slide that Mr. King had there about all the developments in the industry recently, but increases in demand, better scheduling, Asian imports, a lot of things I think have changed such that the returns of the rail industry are now much more like the overall economy. Before there was some insulation, maybe they were carrying bulk commodities more than they are today as a proportion of total traffic. But whatever it is, the market now demands that the rail companies deliver higher returns because those returns are more correlated with the overall market. So it could be a sign of health, but it means their cost of capital is higher.
Right. The literature suggests be careful with beta because it could be reflecting rising prices and health rather than increased riskiness.
Exactly.
That's the exact point I was trying to make. Rates have been going up. Railroads are earning more relative to the general economy. That's what you're seeing. The fact that rates are going up, the fact that the railroads are earning more money, the stock prices are going up. That's not the same thing as saying that investors are demanding returns. They're happy to get them, and they'll of course pay a premium for them.
I have more questions.
Okay. Thanks, Mr. Mullen. I have a couple more questions. I think what you're hearing up here is some interest in the question of whether the mere fact that in this recent year, for example, when the railroads have performed very well financially, that some find it surprising that the cost of capital would go up significantly. And I will say, as a non-economist, when I first saw that, I was a little bit surprised. Just would have assumed, just from generally speaking, and I hope that the distinguished economists here can help educate me a little bit on this. Should I be surprised by that? Is that unusual? Does that mere fact call into question the accuracy and the usefulness of our current methodology? And I'll let each panelist take a shot at answering that if each one chooses to. Dr. Otter.
Sure. If you think about this thing in the context of the CAPM or the Fama-French model or arbitrage pricing theory, basically you have a cost of equity that's due to a risk-free rate, which is driven in part by inflation, and some risk premium, perhaps more than one. So you then ask the question, well, did the expectation of inflation go up? Seemingly the answer to that one was no, or at least not very much. Did the risks go up? And they would have had to go up fairly substantially. If you look at that and you say the answer is no, then you come to the conclusion that there's something wrong with the model. I think from what I looked at, I think that the single biggest problem or the most obvious difficulty with your current technology is as soon as I put in a couple more periods and allow that growth rate to come down, then all of a sudden the number drops a lot. And so if I look at that, I say, well, gee, there's something, a problem with the model. Well, from playing with models in the classroom and so forth, this model is tremendously, your current model you're using is tremendously sensitive to the growth rate. Why do we think that the growth rate went up? Well, because the analyst forecast went up. But when you project that out forever, which apparently is not the case, apparently their projections are starting to come down, you get a result that's driven by just the G part. And so you say, well, all right, things are good, but did that mean that the cost of equity went up? And the normal answer would be no. The cost of equity stayed the same. We had some good times. We got some profits. The price may have gone up, but the cost of equity didn't change.
Mr. Stengel?
Chairman Nottingham, I think your original sort of puzzlement over why would the cost of equity go up when the industry is doing better financially, I think that's a good question, frankly. I think it's somewhat counterintuitive. But the cost of equity is what investors demand for a rate of return. And since they're no longer looking at railroad stocks as the equivalent of, the local gas company, they're saying these are vibrant companies that are carrying the nation's goods, and most of the Chinese imports that consumers are demanding, all those flat panel TVs or all the automobiles in the world, they're saying, I want a market return. I want the S&P 500 last year earned 15%. That's the rate of return they want to earn if they're going to hold a railroad stock in their portfolio. Maybe several years ago, they might have said, okay, I don't need that type of return because I'm not taking as much risk. But the risk of holding railroad stocks now is considerably higher because their returns do vary. So, I mean, maybe we have a disagreement here, but I think the cost of capital has increased for that very reason.
Mr. King?
Well, I sort of agree with both of my prior speakers, but the function,
the end part.
Yeah, the function of return to equity is a function of risk, and risk has nothing to do with doesn't have much to do with how profitable or unprofitable a company is. It has to do with how predictable those profits are, whether there is a likelihood of extraordinary increase or extraordinary reduction in the earnings of a company. And that is presumably the measure that beta attempts to get to. And the betas indicate that, at least the betas I've looked at, I haven't looked at these others that Mr. Stengel put on, indicate that the railroads are currently around the level of the overall market. The reason you get the alleged increase in the cost of equity has nothing to do with increased risk. It has to do with these analyst projections. And that's what drives the rather mechanistic way that the board has been calculating equity return. A short time ago, Dr. Stengel said that it is inconceivable that the railroads could indefinitely keep on earning the kinds of increased returns that they have experienced in the last few years and are projected to experience in the future. And that's exactly my point. You have to put in a factor that modifies this implicit assumption built into your finding of last December, that indefinitely the railroads are going to experience a 13.66% improvement in their earnings each year. That can't happen. And that's why I recommend a modification using the two-step method that FERC has proposed. There's been a lot of objection to the idea of any formula and a suggestion that we should look at a whole lot of range of equity return estimations. You can do that, and that's what every public utility commission does. But it only does it after it's received lots and lots of testimony, conflicting testimony, many, many estimates, and then usually the commissions sort of pick a number because there is no mechanical way of performing that calculation. And that'd be your choice, to go into that kind of evidentiary hearing each and every year to find the revenue adequate number. The alternative is to stick with the formula, but make the formula a little more realistic than the one you're using now.
So it sounds like, Mr. King, you would agree with Dr. Hodder then that our current methodology weighs growth disproportionately, the growth factor disproportionately drives that upward?
Yeah, it does, but that can be fixed if you fix the growth factor, so it doesn't include an irrational assumption. that irrational assumption being that this kind of increased growth will continue indefinitely. And that's exactly why the FERC picked its formula, because the pipelines were also being forecast to increase their earnings at astronomical rates. And the FERC said, no, this isn't possible. We've got to modify this formula so that we bring it down to something that reflects the long-term probability of improved earnings.
Dr. Stengel, is it a irrational assumption that growth will continue forever at 13 whatever percent?
Well, it's not irrational. It's a feature of that type of model. Is it realistic? No, but it would be a problem if you didn't return to this question every year. If you set that in place and said, okay, we're going to go to sleep now and not return to this question year in, year out, then that would be a problem. In fact, if you set the thing too low, you'd starve the industry of capital if you set the rate too low. If you set it too high, we would have a railroad running down every street here in the city. But you couldn't pass the environmental impact statement. But the fact is, there are market forces out there that will prevent this from getting out of whack. And since you do re-examine the question every year, the feature of the model is not as big a problem as the critics make it out to be. It's a matter of practical implementation.
Mr. Motes, you touched on, and others, that when this was looked at in the past, some 20 years ago, the parties had different recommendations for us. I believe some of your clients were on the other side, if I understand it correctly. I wasn't around here either 20 years ago, but that the railroads were basically arguing for more of a cap-M approach, and is that fair to say, and that the shippers were arguing for the approach we currently use?
My memory may not be perfect on this. In fact, I'm pretty sure it isn't. And there may not have been the railroads, at least at that point in time, we had filings by the eastern railroads and the western railroads. And they did not always meet perfectly. But as a general proposition, I wouldn't be surprised if that may have been true. I don't know that any of the railroad interests were advocating CAP-M exclusively. There are people in this room, I'm thinking of Mr. Rocky back there, for example, who would be able to correct me on this, but I do remember the shipper interest being very unhappy with the use of the CAP-M later on, once the DCF had been embraced by the ICC and it began to generate annual revenue determinations. And the ICC, as I said before, did, I think in the late 80s, eventually stop doing the CAP-M even as a cross-check on the DCF results. But I honestly don't remember exactly what the different railroad positions were at the beginning. As you know, this thing started not many years after Staggers, early 80s, and it went off for quite a long period of time.
Vice Chairman Butcher. Commissioner Mulvey,
This came to mind was sitting here. We have a little table we put out about the railroad cost of capital and the how the performance of the individual railroads in making that cost of capital. And as people have noted, one railroad in the last couple of years has earned its cost of capital. None of the other class ones have. But if you go back into the 90s, the middle to late 90s, some of the other railroads did earn their cost of capital and did it quite handsomely. And those were the Soo Line and the ICC and some of the other railroads that have since been absorbed into Canadian railroads in part. And what was the economic condition of those railroads at the time that they were earning their cost of capital so handily? Do anybody recall? I see some gray hair there.
Well, you must be looking at me. So.
Yeah. I think there's a couple of elements that might be this. I'm just reflecting my own personal observations of a few years in this industry, around this industry. The Soo Line was an overhead railroad. And their costs were considerably lower. I mean, they just grabbed trains from the CP and took them to Chicago, and that was it. That's not a hard thing to do and hard to run. So as they acquired and ran their property. And the IC, if you recall, through the, I believe it was the late 80s and early 90s, they built a double-track railroad. And the new person that took that over decided we're not going to run a double-track railroad, we're going to park one, and we're going to run down the other one. And then when that one wore out, he went down the other one. So he didn't have to invest anything. So there were some economic models and situations. And one of the things that this points out, I think very clearly, and Mr. Moose, I want to compliment you on your thing that you're absolutely correct, that the record has no indication whatsoever of any flaw. It's the economic realities in the marketplace that recognizes the flaw. And that's even Chairman Nottingham points that out. This doesn't make sense. And that's what I said in my statement earlier. It's about balance and finding this thing. But I think if you go back and reflect on those two railroads, what happened, that's kind of my view, certainly not the league's position necessarily, because I don't think anybody could go back that far. But those were two different railroads and two different environments. I assure you that probably the DNRGW would have been revenue adequate if it had been through those times, because for the same reason. It picked up traffic here and handed it off over there and didn't do a lot of stuff, so its costs were down. So.
Well, Mr. Ficker is right to a point, and he has a very colorful way of expressing it. There's some other things going on there, and the Grand Trunk Western should have been thrown in there too.
Right.
It also,
One, yes, GTW.
and it's also part of the Canadian National today. A lot of what the results showed for those railroads in given years had much to do with the way costs and revenues are allocated as between the Canadian and the U.S. portions of the systems. Had an awful lot to do with it. And you would see, if you go back and look, and you apparently have, thank you, there are some pretty wide swings in different years for some of those railroads you're mentioning. They'd be way above revenue actually one year, way below the next. Had much more to do, I think, with the allocations of the revenues and expenses than with how they were actually doing.
Figures lie and liars figure?
The Canadians aren't here, so I don't want to cast aspersions on their oversight of that. The other thing, though, and Mr. Ficker's right about this, the Illinois Central, the old Illinois Central Gulf, it was the combination of the Illinois Central Gulf, Mobile, and Ohio, had quite a sprawling network in the south. There was a very, how shall we say, a rigorous slimming down of the physical plant over a fairly short number of years, so they ended up with a very efficient plant, Chicago to New Orleans, double track, very little structure otherwise, and that was a very efficient railroad. But the last thing I'd note about this, you know, in the years of the Illinois Central and the Soo Line and the Grand Trunk were all substantially above the revenue adequacy determination. Not one of those railroads ever had a rate case. So that tells you something.
If I can interject my own 2 cents about this, I think if you went back in particular to the early 90s, if you looked at the main railroads, including those that had rate cases, you would look at they were making substantial progress towards revenue adequacy for that time during the early 90s. I actually think if you look at the two-year beta chart that Dr. Stengel constructed, it would show high returns for that period. But then what happened is that the railroad industry engaged in a series of mergers, which had some very adverse consequences for shippers. It had some adverse consequences for the railroads at the time, and that's one of the reasons why there wasn't progress. Revenue adequacy wasn't achieved a few years after that because of those decisions.
It does seem to me that these two approaches, the discounted cash flow and the CAPM approach, both of them are subject to volatility of certain assumptions. For example, on the DCF approach, it's the volatility of the analyst forecasts, and we saw in some of the testimonies how wide they ranged. On the other hand, on the CAPM approach, there's a lot of variation in the estimates of beta. In your opinions, are either one of those more or less reconcilable than the other?
Well, mechanically, if you use the same data, the same time period, the same data frequency to estimate beta, you're going to get the same number. Now, the issue becomes really what is a forward-looking number. You're not really interested in what was the number 5 years ago. It's essentially what do I think is the best number to use now going forward. And, in fact, people have gotten into business of forecasting betas. They take the stuff from the past and they make adjustments. I think the issue with the DCF approach is not only the analysts, the variability in the analyst forecasts, but if you parcel this thing out and you say we got 3 phases, you say, well, okay, so what's the growth rate in the second phase? And when does the second phase start? And how long does it run? And, those things are judgment calls. And that's the issue here, is with any of these, you're going to get some variability across reasonable people who are going to come up with somewhat different answers. And what you just try, in my view, is you try to narrow it down and try to, get it into a range where it's 1.5%, as opposed to 5 or 6.
Dr. Stengel?
As I said earlier, the virtue of your current method is you don't have these controversies or judgments to make. And I guess one choice you face is how much staff resources do you want to devote to this? I mean, you could have a very long hearing with a lot of expert witnesses around time period for beta, how many adjustment periods and transition phases to have with DCF. Frankly, I think you're going to, if you have two different methods, it will be a rare year in which they are within a percentage. You're going to have wide dispersion. You're going to have a lot of controversy. Are you willing as a commission or a board to devote all the resources necessary to resolve those differences?
Still, you would agree it's an important issue and one that we should get right if at all possible. I mean, or get as accurate a measure as possible. So, and of course, there's volatility, as has been pointed out in the analyst forecast as well. And if you only have a handful of analysts, and that group of analysts could change, and you begin getting variability based upon which analysts you're looking at. There's also talk about using a two-step approach where you would have, well, in the case of the FERC approach, where you have a short period of time. By the way, there's no time period, right? That's 2/3, 1/3 is...
It's 2/3, 1/3, but the presumption is that the 2/3 is a sort of 3 to 5 year framework, and then the other 1/3 represents the remaining
years, okay.
periods of years.
So it is a 3 to 5 year period for the 2/3.
Well, that's what the analyst reports are. Okay. Essentially, certainly I know Value Line predicts the 3 to 5 year. Well, no, 4 to 6 years, and we settle on 5 as being the forecast.
And your approach was to do, say, maybe a three-stage approach where you would have 0 to 10, 10 to 20, and then on out and from 20 to infinity?
Well,
as an example.
If I was doing it for openers, I'd probably do 0 to 5, 5 to 10, and then to infinity. And for example, that's the approach that Ibbotson uses. But I would suggest that what you would do is you would take testimony and you would try to decide what you thought was the most reasonable way to implement that, and then say, okay, we're using 0 to 5, 6 to 8. Whatever you thought was a pretty reasonable way to do it. I think one of the benefits here is once you go to the multi-stage thing, you don't get nearly as big a swings, and so that narrows it down quite a bit there. I think the other benefit is that because you're now focusing on growth rates, whereas then when you go over to the CAPM or Fama French or whatever, now you're talking about risk. Okay, risk is in the DCF model, you just can't see it.
How do the railroads feel about the adjustment to the DCF that would take into account Dr. Harder's suggestion that we drop the assumption that the railroads grow forever at the high rate and segment it into a short-term, intermediate-term, and long-term growth rate?
We would welcome the opportunity to comment on that in a formal rulemaking. No, seriously, I don't think I cannot, on behalf of the industry, give you an answer to that today. I think our position remains, coming into this hearing, that we don't believe there has been a requisite showing to require you to do that. But if you do go forward and you do want to have comments on the methodology, on the implementation, all the rest, I'm confident that the industry will do its best to be able to express its position, but I can't do that today.
Thank you. Dr. Stengel, you want to go any further than that?
Well said.
Well said. There was also some suggestion about the looking at the capitalization or the debt equity ratios of the industry, and right now we weighed our analysis 2/3 equity, 1/3 debt, and there was some suggestion that if we switched the way we measured the equity from market-based to cost-based or replacement value-based or whatever, that would change the result. Has anyone looked at what the size of that change might be and what the impact of that might be? Replacement cost would be very, very difficult, but Would book value be, or would book value too much subject to?
I have the book value calculation in my statement, and
I thought you did that.
it is on page 18 of my statement.
Okay.
And you lay that side by side with the board's calculation in its order of last December, I think you'd be able to see the difference. It's effectively 50-50 on book value basis. I believe it was like 60-40 equity debt on a market basis.
I think now it's almost 2/3, 1/3, isn't it? Yes.
Yeah, it
It's
could
gone
be
up.
even greater now because of the bid up of the market prices.
Mhm.
Commissioner Mulvey, I believe that, for example, at FERC, when they were working with cost of capital issues, they look at what would be an appropriate debt equity structure to begin with. That's one of the first steps. I believe that it's subject to chapter. It's fairly common to have a 50-50 debt equity makeup, for example.
Mhm. Okay. Anyone else on that?
Thank you, Commissioner Mulvey. It occurs to me that businesses, for many good reasons, probably make their own cost of capital calculations on a regular basis. Is that, first of all, let me just get a quick, is that fairly common practice, Mr. Moats, in the railroad business, that your clients would have reason to make cost of capital determinations for their own internal reporting, or, and I'll ask the same question to Mr. Ficker or others, Mr. Rosenberg, who represent business?
I'm confident it is the case that each of the railroads determines what it thinks its cost of capital is, because it actually has to go out there in the market and secure that capital in a competitive environment. How each one of them does it, I really don't know.
I would concur in that assessment. Having been in the private sector for many of my illustrious years, that is done at different corporations in different ways. They have their own internal reviews of what their cost of capital is versus their earnings, and depending on the nature of their industry. Some are capital intense, others not. I spent time in the forest products industry and the paper industry, and it was very capital intense, and those decisions are made every year, reviewed every year internally.
Mr. Rosenberg?
Well, for utilities, they'll often have to get regulatory approval to issue debt, to issue capital. Utilities are also, if we're talking electric utilities, and I don't think I'm too far inland with natural gas pipelines, they are subject to pervasive regulation. All of their rates are regulated, so the cost of capital is certainly taken into that account. Again, one of the questions I made in my initial comments is that we've seen no indication that these figures that the board uses are what the railroads actually consider in their own internal calculations. It's this was one of the dogs that didn't bite, and I think Dr. Hodder can also address how firms look at their internal cost of capital as well in a variety of contexts.
Well, it's certainly a very standard procedure that would be done probably annually. And I think the expectation usually is it didn't change a whole lot from one year to the next. And the typical approach, I think, starts with the CAPM and uses some kind of discounted cash flow as a cross-check. I would say the rationale for that is sometimes firms are trying to figure out, well, what should the cost of equity be for some project that's not traded in the market, so it doesn't pay dividends, et cetera. And they want to go in and they want to estimate a beta for that project and perhaps adjust it for the capital structure of the project. And the CAPM lends itself to that sort of a procedure. But the basic sorts of things I advocated to you is what I would expect a good chief financial officer to do with his staff. He'd say, come in, give me the numbers, give me the ranges, tell me about the inputs, why did you pick this one, what are the other alternatives, and then they would make a judgment.
I would say that the question does bring to mind a little bit the somewhat related complaint we've heard in rate cases from time to time, and the board has been pretty consistent in answering the same way the railroads have. That is, railroads, you must have your own internal way of costing things, so why don't you produce those internal costs and we'll compare them to the way the regulator does the costs. I'm sure that the railroads, just like these other businesses, have ways of calculating cost of capital for different purposes, for purposes of determining, as I said, how to go out and try to compete for scarce capital in the marketplace. We all know they have their own processes, including determination of hurdle rates they have to clear for approval of projects and the like. But I'm not sure that those methodologies, which I'm confident are all over the map too, would inform necessarily your determination of what the industry cost of capital should be. And having said that, I also suspect they're viewed as fairly highly proprietary, which is at least one of the reasons I don't know what they are.
Well, Mr. Motes, with all due respect, I know some of us may have a higher degree of respect for your client's abilities to, to me, it'd be very meaningful to see what the industry actually, albeit potentially confidential, and we'd have to be careful in how we tread in this area, but very meaningful to see how the actual industry that we're proposing to determine how they actually look at it themselves, in some, whether we need to do it in some masked way or some way to protect confidentiality. Similarly, really, for Mr. Ficker, some of a sampling of his members, just to get a sense as to whether the way the railroads look at their cost of capital is consistent with other complex business organizations. And it's, as a government agency, trying to make a snapshot decision each year on what's going on out and what market conditions are out in the economy. I mean, it'd be very meaningful to see how the benefit of your members' experience. I don't know if there's a way. Would you at least be open to trying to work with us to figure out a way to help us better understand that while protecting confidentiality and business secrets?
I'd absolutely be open to conveying back to the members of the association your desire. Really, I'm not trying to be coy. I really don't think I'm in a position to sit here and say yes. I mean, we want to be helpful, but I know that there are great sensitivities that the CFOs and the controllers and the others have about the methodologies, the numbers, and the like. But we certainly will go back and consult on that. I get the message.
Thank you.
Chairman Nottingham, we noted in our comments that a number of the railroads have significant stock buyback programs. For example, indeed yesterday, I think both CSX and BNSF announced substantial continuations or expansions of those programs, and that in calculating whether or not to do that, it involves a comparison of what their rates of return will be versus that of the market, and it's in the best interest of the corporation and the shareholders, so they need to be taking those matters into account in that context as well.
Thanks. I do want to just point out that, Dr. Stankel, your point's well taken about the sheer costs in time and staff hours that changing our procedures could trigger. I will say, though, that something that is this important, and we're spending a lot of time on related issues that are driven by this very data, whether it be in rate cases or in the whole range of issues that come from rate cases. And so we're laboring hard on trying to resolve disputes that are really all about this data when you start peeling, or much about this data. And so, to my way of thinking, that's the time and effort's not going to be the foremost concern. It's going to be, are we where we should be now? Is there a better, more accurate approach that we should be taking? Because if there is, I think it's worth any effort, because it's that important an issue.
Very good.
That concludes my questions, Vice Chairman Buttrey.
I have one more. It's testing everybody's kidneys. But at any rate, on this issue of the capitalized leases, the Western Coal traffic lease suggests us that when the railroads make their presentations on Wall Street, they gap the sides, a non-gap presentation. They take the capitalized leases out, and but on the other hand, if you did that, you would have to you take them out of the expense category, and you put them in the base for calculating rate of return, right? So wouldn't that offset to some extent? I mean, I did some back at the envelope calculations on that, but.
Well, you'd have an offsetting calculation. The asset base would be increased. The expense would be reduced. But that's what BNSF in particular is explicit that it does with its Regulation G pro forma, and the indications are in calculating its incentive compensation for its executives. That's the calculation it makes. And that also is the calculation that Wall Street makes as well.
That would improve,
at least by the reports that we attach to our testimony.
And that would improve its return, although. Okay. Do you want to comment on that?
No, I really can't.
That's the same issue as before,
Yeah,
yes.
I mean, I referred to the portion of my prepared remarks at page 11 when we addressed that. I'm not familiar with the BNSF.
It does run against, you're right, it does run against the GAAP principles, but it's a non-GAAP presentation.
Right, and we did attach it to our filing.
I do know that BNSF and UP note that it is non-GAAP when
Right.
they file with you.
And the SEC would, requires that explicit mention.
Right. Well, thank you. Questions?
Well, that concludes today's hearing. We appreciate all the witnesses' time and patience today. It's a very important topic, clearly. We look forward to continuing to work through this, and again, very much appreciate your participation. With that, we are adjourned.